What we have on the screen right now is the simplified mechanical trade plan on the right hand side and the charts on the left hand side. So usually when I'm marking on my charts, I'm going to be having the trade plan open right next to my chart so that I can just refer to it and ensure that I go through the checklist inside the trade plan itself. Right, and if there's a trade that meets the criteria, I'll take the trade, and if there's no opportunities, then I'll just stay out of the market. It's really important that you have some form of structure in your trading, because if you want to get consistent profits, you need to have consistent actions. Right, so having a mechanical trade plan just like this allows me to trade with confidence without guesswork or emotions whatsoever. So first of all, when we look at this chart on EURUSD, understand that for this simple strategy, we are only going to be using one time frame, and that is the 15-minute time frame. So you can see the first step right here is to identify the 15-minute structure and the trend, right? So we know that price went down, pull back, and then goes down there and break past that last swing low that we have right here, giving us a bearish break of structure to the downside. Now, once we got this bearish break of structure, this is where we can identify our 15-minute swing high and our 15-minute swing low, right? So this is the 15-minute swing high because this is the highest point that led to the break of structure. Okay, so this will be our new 15-minute swing low right here. So in a downtrend just like this, we are expecting price to break past the low, right? Just continue creating lower highs and lower lows. So right now we have identified our 15-minute structure. We know that price is bearish, and right now, since price has just created a break of structure, we're anticipating price to start pulling back. Now, based on this, where is price gonna pull back to? Okay, it's most likely gonna pull back to some form of discount and premium pricing. Okay, so let me just change this order right here in the checklist. There we go. So in a downtrend, we are expecting price to pull back to the premium pricing, and in an uptrend, we are expecting price to pull back to a discount pricing. So now let me just draw the premium and discount from the swing high to the swing low, just like this. And you can see right here, this is the premium pricing and this is the discount pricing. So as usual, we are expecting price to pull back into this premium pricing since price in the downtrend. And then this is where more sellers will step into the market and cause price to go down even further. So at this point of time, we are still waiting to see what price does. We are still waiting for price to pull back to the premium pricing. You can see price just consolidating right here, and eventually it starts making that massive pullback into the premium pricing. Okay, so we check off the second box right here. Now, the third step is to determine where is the available liquidity, right? So when I'm looking at this swing range right here, we know that there is available liquidity above average swing high and below average swing low. And in the downtrend, just like this, we are looking for available liquidity above the swing highs to be swept. So based on this, we saw that price went down, pulls back, and then goes down even further, right? So this just tells us that there is available liquidity above this swing high itself. So that is why I put a liquidity indicator right there to tell me that right now price could potentially come up there and sweep the available liquidity above this high before it actually goes down. Okay, so based on this, we can also draw our supply zones. So this is a supply zone by itself because at this point of time, large amount of supply step into the market. And then there is also an extreme supply zone that we have right here. Okay, so this extreme supply zone right here is really the last line of defense because it's also our 15-minute strong high, right? So this zone has to hold in order for price to remain bearish. Okay, so now we know that there is available liquidity above this high. An additional step would be to look on the left hand side to see where the price sweep liquidity previously. Right, so if I look towards the left hand side right here, I saw that price went up, pulls back, goes up, pulls back again, and then goes up, pulls back, and then eventually goes up there, and then does like a sharp down move, right? Have like a sharp V-shaped reaction just like this. And this is where we saw price sweeping the available liquidity from these highs right here before we get a strong move to the downside. And that strong move led to a break of structure, right? So based on this, I know that this right here, price has already swept the available liquidity above these highs, and then supply stepped into the market and caused price to go down just like this. So this is not just an ordinary supply zone. This is a high probability zone because it swept liquidity, right? So we have determined where the available liquidity is right here, which means when price actually comes up and approaches into this particular supply zone, we want to see this liquidity to be swept first, right? And just as expected, price did not hold at this supply zone whatsoever, because once again, this is where all the retail traders who enter for a sell right here place their stop loss above this highs right here. So remember, smart money needs some form of liquidity before the real move can actually happen. Okay, so now this zone has been demolished. Price has came up here and swept the available liquidity that we have above this swing high. This is where price has entered into our high probability supply zone that swept liquidity, right? So this is a high probability zone. Remember, we want to preserve our capital for the high probability zones. We don't want to take trades at low probability zones. We don't want to waste our hard-earned money on low quality setups which do not work whatsoever. We want to trade at a high probability zone and trade with precision. So the minute price enter into the 15-minute high probability zone that swept liquidity, what you could have done is that you could have placed like a sell limit order right here, okay, just like a sell limit order right here at the edge of the zone itself, and then in that case you will place your stop loss above the zone, and then for your take profit you just place it at 3R, right? So you target 3R just like this. Okay, very simple trade, right? So if you just go back by one candlestick bar, you can see the minute price step into this zone, you place your entry limit order right here, you are into the trade, right? So at this point of time, boom, you are triggered into the trade right here, and then price just starts going in your way, and just like this, you've gotten out of the trade within like 30 minutes or so. You have closed the trade with a 3R profit, literally as simple as that. And just like that, we have went through all 5 boxes, right? And that's really how you carry out this entire trade process. Okay, so another bonus tip would be to actually go down to the 5-minute to refine your zone if you want, right? So based on this, you can see, right, how we dropped this 15-minute supply zone was that we took this entire range that we have right here. But if you go down to the 15-minute time frame, you could probably refine this range right here to like this particular candle but itself, right? So if you do that, right, look at this, you have gotten like a much better risk to reward. And this is really how we get those sniper entries, by going down to the lower time frame and refining the zone, making the zone even tighter so that your stop loss is also tighter as well, right? So yeah, that's that. So now what's next, right? What's next? Before I go and show you more examples, I want to explain to you what are the rules that we have inside this simplified trade plan. So this is the trade process right here, which I've already explained to you, and this is the trade management rules that we have, which states that we are taking full take profit at 3R itself. Okay, and we are also going for the set and forget method. That means we are not trailing our stop loss, we are not moving our stop loss, we are not taking partial profits whatsoever. Once we enter for the trade, we place our stop loss, we place our take profit, we just let it run, right? We trust our analysis. And if you look at this trade plan right here, the last thing that we have is our capital management rules. It's imperative that we have some form of rules to actually protect our downside, to protect our capital, right? So that we can actually reduce our losses. Just by reducing your losses, you are already halfway there to becoming a consistently profitable trader. So our capital management rule states that we are only going to be risking 1% of our total capital per trade. So if we have $100,000 in our capital, that is where we will only be risking $1,000 on each trade, right? So based on this, I will go on to a lot size calculator and determine what is the correct position size that I should be using based on my stop loss and based on my risk per trade. The next rule is max 3 losses per day, right? By having some form of max loss rule, this allows me, or rather this prevents me from over trading or revenge trading, because the last thing you want is for you to lose one time and you start getting angry at the market, you start punching your monitor, and the next thing you know, you enter another lousy trade and you lose even more money and you feel even more angry, and you just go into this downward spiral of revenge trading and over trading. So set a rule to limit the amount of losses that you can incur per day. So for me, that's 3 losses, right? Which means I essentially have 3 bullets per day, right? So I have 3 trade opportunities per day. If I trade 3 times and I lose all 3 times, I'm done trading for the day itself. I'm going to be closing the laptop, I'm going to be going to the gym, going for a walk in the park, or I don't know, just sit down there and watch Netflix or something if that's what you like. Now, I also have a rule that says that my stop loss has to be minimum 2 pips, right? So it cannot be less than 2 pips. The reason being, when you are scalping, right, when you are participating in high frequency trades, right, you're entering on the lower time frames, and that is where you can have like this insane stop loss. Like for example, right here, if I entered on the 1 minute time frame, I place my stop loss like this, right? When it's so goddamn tight, you must be very, very careful, because remember, there is a spread, that is a bid and ask spread that you actually pay to the broker when you actually enter into the trade itself, right? So by having like a minimum 2 pip stop loss, this takes into account the bid and ask spread as well, right? To ensure that I don't get stopped out because the broker is being stupid. So yeah, for the love of God, give your stop loss at least a little bit of breathing room, make it at least 2 pips. And as for the pairs that I'm trading, I'm going to be trading the most commonly traded pairs, EU, AU, and GU. And then as for the time, this is in Singapore time, but this is actually the London session or the New York session itself, right? So if there's no opportunity in the London session, sometimes I will trade during the New York session. So yeah, that's pretty much the entire simplified mechanical trade plan. Now, let me show you some more examples. Now, after you have got out of this trade right here, what I'm going to do is that I'm going to erase this and I'm going to start re-evaluating the situation, right? So I'll probably just get rid of all these little drawings that we have right here, because I have chart OCD, because yeah, I'm just a tidy freak, all right? So yeah, let's see, price goes down. Okay, price goes down, boom, there we have. What do we have? We got another break of structure to the downside. Now, the minute this actually happens, that is where we know that what is price going to do right now? Price is going to start pulling back, right? And once price starts pulling back, that is where we can identify, once again, our 15-minute swing high right here, and then also our 15-minute swing low. Okay, so you can see, just by having this mechanical trade plan, you have so much structure in your analysis, in your thought process, right? So based on this, we saw that, okay, that's the first step, identify 15-minute structure and trend. Cool. Now price is starting to pull back, right? Price starting to pull back. That is where do we want price to pull back to? Actually, we want price to pull back to our discount and premium pricing. Okay, so based on this, I'll probably mark up my premium discount from this high to this low right here, just waiting for price to pull back to the premium discount. Dun, dun, dun. There we go. Okay, there we go. The minute price pull back into the premium discount, just like this, the minute it crossed above the equilibrium right here, this is where I can just check the second box. Third step is to determine where is the available liquidity. Once again, right here, look towards the left hand side right here. What do we have? Price goes down, pulls back, goes down, pulls back, and then goes down even further, right? So there is swing highs right here, so we know that there is available liquidity above this high itself. Okay, so based on this, we can also identify that there is also our supply zone right here, and then there is also our extreme supply zone, same as the previous scenario that we have right here. And as usual, we are not going to be expecting this near zone to hold, because this zone right here is just for price to smash right through it to grab available liquidity above these highs before price could potentially come into this extreme zone, and then we got the real move to the downside itself. Okay, so let me just remove that once again. Okay, so that is where we can check off the third box. Now, the fourth step is to enter at a 15-minute high probability zone that swept liquidity, right? So if we look towards the left-hand side, did this zone swap liquidity? Yes, it did. Because what happens is that price goes down, pulls back, goes down, pulls back, goes down. Available liquidity is being built up above these highs right here. Forgive my ugly drawing, but you get the point. Before price comes up there, sweep all the available liquidity above these highs right here before we got a sharp down move, that sharp V-shaped reaction, which we love. So based on this, we know that this is our 15-minute high probability zone that swept liquidity, right? It's a high probability zone, baby. So it's time to go, all right? It's time to go. That is where we want to place our entry limit order, right? Place our sell limit order at the edge of the zone itself, place our stop loss above this zone, and then place our TP at 3R, right? Potentially 3R right here. Or in this case, I'll probably just target like right here at this last swing low right here, because we are expecting price to take out this swing low as well. Okay, Now you can see this is one of those scenarios where the stop loss could be a little bit wide, right? So this is where you can really jump down to the 5 minute and refine the zone, right? So in this case, I'll just refine the zone to like this particular candlestick like this, and I'll place it at the edge of the zone itself, right? So how I usually refine the zone is that I just refine it from the entire range to that one single pivot candle that led to that down move. Okay, so based on this, let's see what happens next. Can see right here, price come up there, tap us into the zone right here, tap us into the trade right here, and let's just see what price does. Eventually price comes down, collapsing, and boom, smash our TP. As simple as that, guys. And in this case, this is a 1:4 trade, right? So yeah, based on this, you can see we are not utilizing multiple time frames like we usually do. We are just using one time frame. And just having this simple 5-step process, it keeps things simple, keeps things mechanical, and most importantly, profitable. Okay, so as usual, once again, after I got out of this trade right here, just gonna clean up the drawings, reevaluate the entire situation. And right now we saw that there was another break of structure to the downside, right? So as you guys know, right here, we're just trading with the trend, right? We are not looking for counter trend trade setups. We are not trying to buy in a downtrend. We are just trading with the trend itself, okay? So once again, just restart this entire process. That is why these check boxes are so useful, because once you are done, you can just uncheck them and then you can just redo the entire process. Okay, so you can see right here, this one was a very sharp one. So you can see this one was a very, very fast one. If you were too slow, you have missed it. All right, so let's just go back a little bit right here and see what exactly happened. Okay, so based on this, price goes down, pulls back, goes down, pulls back, goes down, pulls back. So based on this, we saw that there was like a little downward trend line, right? And we know that when it's a trend line just like this, that is just available liquidity being built up. Because what happens is that all retail traders, they are trading the trend line, they are selling right here, placing a stop loss above this high, selling here, placing a stop loss above this high. So there's a lot of available liquidity above all these highs right here. And then based on this, we saw that this is our extreme supply zone. Once again, that swept liquidity on the left hand side. And then this was that available liquidity, right? So based on this, we are waiting for price to pull back to the premium discount right there. And this is that particular zone that we want to enter on. And bam, you can see, boom. This is why you gotta be quick, you gotta be fast, you gotta think on your feet, right? The minute you got out of the trade, just clean up everything and reevaluate the entire situation, right? Don't sit there and celebrate. No, you gotta keep going, bro. You gotta make as much money as possible. So at this point of time, boom, you could have easily been tapped into this trade right here. Sell limit order at the edge of the zone itself, TP3R right here, boom. Another day, another W, another day, another trade, another trade, another W. Within 30 minutes itself, you just hit 3R just like this.